Hello and welcome. You're listening to the Investor Lab. You're joining us here live if you're joining us here on YouTube. And if you're not joining us here live, then you are joining us here not live. And you're listening to a recording somewhere in the cybersphere. But welcome to you as well. Hello, everyone that is here joining us live. Robert Willis, great to see you here for the first time. Hope you stay awake, even though it is the end of a 12-hour night shift.
Ooh.
So thanks for joining us. Gringa Chica, we see you there. Claire Westra, g'day. Good to see you. Matthew Pitt, Rich Weber, Charlie Bella, Kishan. Great to see you guys all here.
What a
Good crew.
turnout, guys.
Yeah,
Welcome.
I'm
Hello.
sure there's plenty more people to come and plenty more people here as well who haven't let us know in the chat. But if you are here, let us know in the chat. Nice to see you guys. The reason we do this live is so that we can be here with you and have a conversation. Gabby, how are you today?
I'm good. I was testing out this thing where I didn't say anything whilst fading out the music, and I think it helped.
No,
I think it helped.
You know, I was wondering how you were going to go because, like, I was like, I can see you dancing. Is she lost in? Is she lost in the dance?
Nope.
She lost in the sauce.
We're good. We're good.
Hey, Neutral Rockets, good to see you, Kim.
Hello.
Kim Powell.
Hello, Kim Powell.
Good to see you, Kim.
Kim Powell.
Kim Powell.
Chris, how are you?
I'm good. I'll be honest, a little tired today. You might notice a little puffiness under my eyes. I tried dunking my head in the ice bath this morning. That didn't seem to do much, but you know,
sure it did something.
Yeah.
Do you feel fresh? No.
Nah.
No. Okay.
That's all right.
Sorry about that.
Look, that's fine. It's fine. It's fine. We're here, and I'm excited to be here. Gavin, nice to see you too. I'm excited for today's topic because it's a big topic. It's a super interesting one. And for those of you who aren't in the Investor Lab community, we actually crowdsourced this. There was a selection of possible topics that we were going to do this week. There was 3 different topics that I was thinking of. One was Bitcoin versus real estate. The other one was how the New Zealand property market crash might affect the Australian property market. And the third one, which I'm really happy that there was at least 3 votes for, was can the US
one of the votes?
Yeah, that's fine. Your vote still counts, Gabby. You're still you're still a human. You're still in the community.
Thank you for noticing.
The other one was will stablecoins solve Triffin's dilemma for the US dollar? And I am for the 3 people who've also voted that was an interesting topic. Thank you, because I actually think it'd be a really interesting topic. But overwhelmingly, everyone wanted to see the Bitcoin versus real estate showdown, so to speak.
Mm-hmm.
And if you're not part of the community and you want to be part of the community, there is a link in the show notes, in the video description, wherever you're watching this. It is free. The only cost of entry is that you're not a dick, is that you're a good person. And you show, we have a no dickheads policy, right? So fine. That's the only cost of entry, is that you're collaborative, you care for your fellow community members, and you add value to the community. That's the only cost of entry. That's the only thing we ask.
We should put that in the terms and conditions, actually.
Well, I'm not sure if you remember.
Of like,
I'm not sure if you went to Meredith Music Festival, but they had a no dickheads policy. They had an official no dickheads policy.
Yeah.
Anyway, so, but we are trying to engage more because there's so many things that we can talk about. So it's great to actually engage with the community to understand, okay, cool, what do we want to tackle? Now, Bitcoin versus real estate is something I was really interested in tackling as well. But here's the thing. On face value, that seems like an easy thing to do. And as I started preparing for this podcast episode on Monday, I realized that there was actually quite a lot to unpack in here. And I think I've spent probably close to 20 hours this week working on this, because there's so many considerations, right? There's the face value type stuff of like, all right, which one's portable? Bitcoin versus real estate. Well, guess what? Bitcoin's more portable than real estate, right? But then there's actually all of the financial mechanics. Hey, Julian, disguised there as Dashdot.
Hello, Dashdot.
Hello, Dashdot.
Welcome, Dashdot.
Hey, Catherine, nice to see you. Hey, and you can finally join the chat, Catherine. Well done. Harpreet, great to see you as well.
Yes.
There's quite a bit in this. And so one of the things that I want to say before we kick things off is that, number one, we are going to be going through a lot of numbers and stuff. There is no way to avoid that. Or maybe there is, but maybe there's no way that I can avoid that, because that's just how I think. So maybe if somebody else was doing this, they'd be able to do it without as many numbers as what I put together. The other thing that I would say is that everything is wrong. And the reason I say that everything is wrong is because everything is going to be based on subjective things like forecasts, assumptions, and a whole bunch of other different things. And if you change any of those, then the outcomes would necessarily change. And so the point of this episode is really to highlight the conceptual frameworks that we can use to compare or to give us a point of reference between these two assets. But noting that when there's 100 variables, you could change one, and the all of the outcomes could be drastically different. So just with that little caveat there, and some of the numbers we're going to use as well, you may say, but they're not realistic to me, and that's fine. The point is, we couldn't tailor this for everyone, so we just picked some numbers and we just said, okay, this is going to be the base case under which we're going to compare them. Does that sound fair enough, good enough disclaimer?
Yeah, awesome. Yeah, and I think like with this stuff, I think everyone wants things to be as black and white as possible because there's a lot to take in the world and to understand. And so the more things that we have that are just like clear cut of like, this wins, this one loses, the easier it is for us as humans, right? The reality is, as we all know in this community listening to this show, it's not always, it's very rarely black and white. It's very rarely one way or the other. And it depends based on you, your situation, your preferences, your starting point, your current point, your goals, all of these different variables come in. So Goose, like you said, you've spent a long time this week, and obviously you think about this a lot anyway, but trying to prepare for this episode, I mean, it's still like, there's still just so much in it. So we've done our best.
We've done our best to sort of keep it simple enough as well. So why don't we get stuck into it? By the way, if you're in the chat and you're here live, let me know in the chat if you are okay if we go deep into the numbers. Hey, Sean, nice to see you here as well. Let me know if you're okay if we go deep into the numbers, because we're going to be going through a lot of numbers. We're going to be showing numbers on the screens. We're going to be talking about numbers. Are you okay with the numbers? Are you okay digging into the numbers? Because I've built models. We've got standard deviations. We've got all kinds of things. Let me know in the chat if you're okay with us digging deep into the numbers. Robert Willis, he says, go deep.
That's a good point. I will actually just point out, because we have a lot of people that tune in just on the audio version. So if that is you right now and you're listening to this, probably do recommend you jump into YouTube and watch the YouTube version so you get all the numbers and charts and spreadsheets as well, because it's going to really help cement your understanding.
Yes.
Where do you want to start, Goose?
Well, I'm going to start at the start. So I'm going to share my screen, and we're going to start with we're going to start with a slide deck. You know how much effort has gone into this when there's a freaking slide deck. Oh, I didn't know there was a share screen version for slides and PDFs. All right, let's get a little bit too audacious. Off we go.
Okay.
Hang on. Make the there we go. Okay, so here we go. Bitcoin versus real estate. Okay, so we're going to start with some definitions. Are you ready to rumble? We're going to start with some definitions. So firstly, Bitcoin is a decentralized digital currency that enables peer-to-peer transactions over the internet without the need for banks or other intermediaries. It operates on a public, tamper-resistant ledger called the blockchain, where transactions are verified by a network of computers or nodes using cryptographic rules. New Bitcoins are created through a process called mining, which also secures the network, and the total supply is capped at 21 million, making it scarce by design. By the way, around 5 to 6 million of them have been lost already. So there's actually less than 21 million that'll be in total circulation. But it's scarce by design. This fixed supply, combined with its global accessibility, resistance to censorship, and portability, has led many to view Bitcoin as both a payment system and a store of value similar to digital gold. So that is Bitcoin. Now, real estate. What do we mean by real estate? Now, I want to be really very clear here. The way that we're going to be defining real estate in this comparison is Australian residential real estate as purchased by Dashdot. We are not taking the Australian national averages. We're not doing anything like that. And the reason for that is you don't want to buy an average property. You want to buy a better than average property. And so we're going to walk through some of the numbers we're going to be using. So in the context here, real estate, as we define it in this showdown, is Australian residential real estate as purchased by Dashdot, and it refers to carefully selected investment properties in high performance growth areas, chosen using data-driven analysis and on-the-ground expertise to maximize return potential. Now, the reason this is important is because you guys will have heard me say many times that I believe that residential real estate represents the best risk-adjusted return asset. That point of view is formed through the lens of Dashdot, not through the lens of arbitrarily just buying any property anywhere, anytime. And so necessarily to create an appropriate reference point, I wanted to view it through that same lens that I see it. So unlike generic property investing, this approach targets the right property in the right place, at the right place at the right time, not the right location. Balancing strong capital growth prospects with manageable cash flow, long-term stability. Properties are acquired based on rigorous market research, suburb-level forecasting, and portfolio strategy alignment, ensuring each purchase is a strategic step towards building wealth. In this context, real estate means quality assets chosen to outperform the broader market, not just any home or investment property. So that is what we mean by real estate in this context. Cool?
Beautiful. Great.
So let's talk about the track record. Firstly, we're going to talk about the track record of Bitcoin, and then we're going to be talking about the track record of Dashdot properties. Dashdot clients purchase properties that clients have purchased working with Dashdot, right? So let's start with Bitcoin. So,
Bruce, can I just jump in just quickly?
Yeah.
Guys, if you're here live, you know that we love you sending through questions as they come up. If you pop in a question, if you have any questions, firstly, that come up, chuck them in the chat. If it's relevant and we can quickly answer them, we'll answer them on the spot. Otherwise, we'll kind of come back to them a little later. But do send questions through, because there's going to be a lot of stuff that comes up that you probably need some understanding of or want clarification of. So just send them through in the chat.
Yes, and despite what Sean has requested, I will try not to do public maths. I've tried to do the maths in private, not in public. So it's fine. Okay, so let's talk about Bitcoin's track record or background. So Bitcoin has strong long-term growth. So since launching in 2009 at near zero value, Bitcoin has grown to become a $2.5 trillion asset in itself, delivering some of the highest long-term returns of any asset in history. It has high volatility with an upward bias. So despite frequent short-term price swings of 20 to 50% or more, so the actual long-term volatility average of Bitcoin is about 50% annualized. Bitcoin's multi-year trend has been strongly positive, with each major drawdown followed by new all-time highs. It's typically had 4-year cycles. So historically, Bitcoin's price performance has followed a 4-year pattern tied to its halving events, where the rate of new supply is cut in half, often preceding significant bull markets. One moment, please. It's also had institutional adoption. So in recent years, Bitcoin has moved from niche tech circles and crypto, cypherpunks and stuff like that, into mainstream finance, with adoption by major corporations, investment funds, and publicly traded companies. It's also significantly outperformed over the decade. Over the past 10 years, Bitcoin has outperformed equities, gold, and most other asset classes, even accounting for its extreme volatility. Okay?
Cool.
So, but let's take a little look, because this is actually something that's pretty interesting. Over the last 4 years, so you'll see here, if you can see on the screen, if you're watching this on YouTube, if you're not watching this on YouTube, you should be watching this on YouTube, because that's where all the visuals are. So if you look at this chart here, you will see that I've created a measurement period from Friday, 13th of August, 2021 to Thursday, 14th of August, 2025, which was yesterday. So I did this yesterday. Now you can see that if we measure between those 2 points, the return of Bitcoin was 157.91%. So that's 157.91% growth over a 4-year period, which is actually just a CAGR, a compound annual growth rate of 26.70% over the last 4 years, which is really, really interesting, because everyone talks about Bitcoin and they're like, oh my God, tens of thousands of percent growth. And it's just, don't get me wrong, it is the fastest growing asset. It's the fastest growing asset that's existed in the human species. It's a once in a species asset, and that's fine and true. But what's interesting is it kind of also depends on over what period you're looking at it and all of that kind of stuff. Yeah. But if you just look at the last 4 years, if you bought on Friday, the 13th of August, 2021, and then you sold on Thursday, 14th of August, 2025, over a 4-year period, you would have made 157.9% or a 26.7% CAGR, which is pretty good.
It's pretty good.
But not insane, right? Like it's not crazy.
Yep.
However, if you had bought it just 1 year prior, so over the 5 years, so Friday, 14th of August, 2020 to Thursday, 14th of August, 2025, that would have been a 60% compound annual growth rate with 948% growth over the last 5 years, which is a big, big difference. Now, the reason that is interesting is because that actually highlights the volatility the volatility that Bitcoin experiences over time. Now, there's a strong argument that volatility is going to go down over time, and I'll talk to that potentially a little bit later. But what's interesting about that is it really depends on the measurement period as to how you would define the compound annual growth rate of Bitcoin. If you looked at the compound annual growth rate of Bitcoin since inception in 2009, then the compound annual growth rate might be something like 80 or 90 or 100%. But again, if you look at it over the last 4 years, it's 26.7%. This highlights the fact that it does have, historically has had significant peaks and significant troughs, and the measurement period really, really, really does matter. So just bear that in mind because it's gonna be relevant to a model that I've built a little bit later on. Okay.
Cool. Just before we move on to real estate, I should have mentioned it in the summary slide that you had. But I read a stat last night just for context of like adoption. I think currently the latest stats is that 32.5% of Australians own crypto in some form, and then 70% of that own Bitcoin. So even that's a much larger percentage of the population. What does that work out to be? Who wants to do public math? 32.5.
I thought you worked it out. I thought you sent it to me.
Yeah, I don't have it in front of me. 22.75% of Australians, now I'm assuming that's adult Australians, own Bitcoin, which I don't know if anyone else is surprised by that, but that's a much bigger portion than I realized. And that's like a couple of months old, those stats, which I just thought was interesting.
Yeah, it is super interesting, right? But owning some and then like what proportion of wealth is also very, very relevant. So like distribution and uptake and distribution and adoption and total value are a little bit different, right? So so Bitcoin is a 2.45 trillion US dollar asset class, depending on when you look at it. So it's had a 26.7% compound annual growth rate over the last 4 years or a 60% compound annual growth rate over the last 5 years. Let's move on to real estate's track record. So real estate, again, we're talking about Australian residential real estate. It's the largest asset class in Australia. It's valued at 11.6 trillion Australian dollars, not US dollars, dwarfing superannuation at 4.1 trillion and listed stocks at 3.5 trillion. And that's according to Cotality's latest report in August 2025, which is pretty awesome. Nationwide participation, so 11.3 million dwellings in Australia with 55.9% of household wealth is held in housing in Australia. So over half of the nation's household wealth, is held in real estate in Australia, which is very important, right? Because that actually creates a structural underpinning for the asset class. There's a high annual turnover. In the last 12 months, it was 526,000 transactions. In some years, it's been as high as 615,000. So typically trends around the 600,000 mark. So 526,000 transactions in the last year is low. But that still equated to $506.6 billion in gross sales value in real estate over the last 12 months. There's been proven long-term performance, so decades of consistent appreciation supported by population growth, demand pressures, and supply constraints, as well as monetary debasement, with an average growth of 8.25% compound annual growth rate over the last 40 years. Now, something that's important to note as well is the 8.25% compound annual growth rate over the last 45 years is really interesting because if you look at the last 5 years, you will actually find, I don't have the exact numbers in front of me, but I think it's like 5.something%.
5 something, yeah.
Yeah, it's in the fives. I think it's in the low fives. It could be 5.15% or something like that. Compound annual growth rate over the last few years. Now, that to me suggests that actually real estate may be positioned for a mean reversion to the upside, to come back to that long-term average and then probably overshoot that a little bit as well. Because it doesn't just grow at 8.25% a year. That's the average, right? So it oscillates around that. Real estate is a reliable hedge against monetary inflation. So property values and rental income tend to rise in line with or above inflation, preserving purchasing power in AUD terms. So that's monetary inflation. And leverage-enabled wealth growth, supported by 2.4 trillion in mortgage lending, enabling investors to magnify returns through responsible debt use. So that's the background for real estate in general. Let's have a look at some of Dashdot's client results. Now, these are relevant because these are important things to understand in the context of how we're going to be approaching the comparable numbers between Bitcoin and real estate. So Dashdot has purchased over 2,000 properties. It's actually a little higher than 2,181 properties. It's 2,200 and something now. We've purchased over $1 billion of real estate. Total current value of properties acquired by Dashdot is $1.277 billion of real estate. That is over the last 6 years. So the average year one capital growth for our clients across over 2,200 properties is 22.79% first year capital growth. That has been measured over the last 6 years and over 2,000 properties. So that is not some, cherry picking our best numbers or whatever. That is a really interesting thing to understand. The average 3-year growth is 62.3%, or it's actually a little closer to, well, actually the numbers that I've used, and you'll see later on, are 22% in year one, and it's actually 60% is what I averaged it out to over 3 years as well. So it was kind of like a little bit conservative on the downside on the numbers that we've used. The median 12-month return on invested capital for our clients, so that's in the first 12 months they've owned a property, is 72.9%, which is wild. That's a crazy return on invested capital. Now, these are pretty astounding numbers, and they are definitely above average. But that is, it's also very important to kind of contextualize this, that this is, averages and medians and stuff. Some people get better and some people get worse. But to kind of give a little bit of context here, these are our top 5 growth results of all time. So property in Rockhampton was purchased for $491,000, and the latest valuation is $1.538 million, and that means it's grown by 213% over 4.2 years. So when we talk about 62.3% growth over 3 years, that's not that outlandish. A property in Ipswich, which grew by 174% in 5.4 years, with a purchase price of $220,000 and a latest valuation of $603,000. A property in Armidale, which grew by 169% in 4.3 years, bought for $310,000, latest valuation $833,000. A property in Playford, South Australia, 155% over 4.5 years, purchased for $216,000, latest valuation $550,000. A property in Kwinana, Western Australia, purchased for $250,000, latest valuation $614,579, 146% growth over 4.2 years. So these numbers are pretty crazy. By the way, if you want to see more of these results and go through them yourself, you can go to dashdot.com.au/results, or you can cruise through. We publish all of the properties that we've ever purchased as long as they've been settled for more than 12 months. That's a rule that we have before we publish the results, but they're all published on that page, and you can go check them out for yourself. Now, the top 5 return on invested capital results. Now, the reason that I'm going through these, by the way, is because I want to ground you in some realities that when we're talking about the numbers, when we see the comparative numbers that we're going to be going through with Bitcoin versus real estate, I want you to understand the point of view that I've got and the conservative the point of reference that I've used to develop the numbers for the portfolio plan. Shout out to Andy Bernardos, or Andres Bernardos, who actually helped to build the plans as well. So here are our top 5 return on invested capital results that our clients that we've achieved. Our clients have achieved over the last 6 years. So number 1, we got a property in Ipswich which had a 967% return on invested capital in 5.6 years, which is crazy. Another property in Ipswich which had an 891% return on invested capital in 5.8 years. Another property in Ipswich which had an 835% return on invested capital in 5.4 years. Guys, these are like nearly 10x. Like, this is crazy, right? So 819% on a property in Rockhampton in 3.6 years, and 805% on a property in Playford in 4.5 years. Now, to give us some more realistic and more recent points of reference, we picked a couple of other properties here as well, just to kind of give a more rounded, more recent view, because some of those other properties were were kind of picked a little while ago. So we've got a property in Port Lincoln, which has had a 577% return on invested capital in just 9 months, based on its latest valuation. So the purchase price $315, latest valuation $829, and the funds required $87,843. Another property in Port Lincoln, which has achieved a 333% return on invested capital in 11 months. Another property in Townsville, which has had a 299% return on invested capital in 15 months. Another property in Port Lincoln, which has had a 249% return on invested capital in 10 months. And another property in Port Lincoln, which has had a 209% return on invested capital in 9 months. So you see, those numbers are pretty out there. So when we talk, if I just go back a couple of slides, when we talk about the median 12-month return on invested capital being 72.9%, you can see how that can happen when you start to look at some of those numbers. And when you look at the 3-year average growth of being 60 to 63% over a 3-year period, you can see how that can happen when you've got properties that are growing by anywhere between 150 and 213% over sort of an average of about 4.5 years, which is crazy. So these are actual numbers that we see inside Dashdot. Now, I also want to talk about some of the suburb performance stuff. Now, I'm going to get back to Bitcoin as well, but again, all of this is a setup for you guys to understand the lens with which I view real estate. And this is very important because, again, this does not, like, you can say Australian residential real estate and you can go and buy a crappy property in a crappy location and get really bad results and even lose money if you're not careful. But the point of view that I've got, and the point of view that we have, and the point of view that I approach my relationship with both real estate and Bitcoin comes from the lens of viewing it through Dashdot. So it's important to set up this context. So bear with me. I hope you let me know in the chat if this is like vaguely interesting to you guys, if you're just like shut the hell up and move on. But I think it's important to set up the context. So I also want to highlight here, so on the screen, we've got our suburb performance benchmarking, where we've benchmarked Dashdot suburb selection, and that's defined as suburbs where Dashdot has bought at least one property and where we continue to buy properties in any given quarter versus the combined capital cities and the combined regionals. And if you look at this table here, you can see that in December 2022, which is when we started tracking this, this is when we started tracking this. Obviously, we started Dashdot in 2019. We just weren't tracking our suburb performance in this way until the December quarter 2022. So in December 2022 quarter, the 12-month average return for Dashdot selected suburbs was 11.3% versus the combined capital cities of 5% and the combined regionals of 3.6%. I'm not going to read all the numbers out here, but what you'll notice is that between December 2022 and June 2025, you can see there's a significant uptrend in the performance of Dashdot selected locations, right? So there's a difference here between properties and suburbs. So what I was talking about a moment ago, this is property results. When I'm talking about this kind of stuff here, these are property results. So 2,100, call it 2,200 properties acquired, 22.79% average year one growth. That's properties. That's based on properties. That's based on actual property purchases. And then separately, we have the suburbs. We have our suburb performance. So if you look at the suburb performance, you'll notice that between December quarter 2022 to the June quarter 2025, there's been a significant improvement in the suburb selection performance results from 11.3% trending up to a peak of 23.7%, and currently in the June quarter, 20.4% average annual growth, or the 12-month historical growth over the suburbs that we've bought at least one property and we're currently still buying properties. Now that is versus in the June quarter, 5.1% combined capital cities and 8.2% combined regionals. To give that a little bit more color, and I'm not going to read out all of these numbers, but you can see here on this chart, and by the way, you can take a screenshot if you want. I don't really mind. You can see here on this chart that in December 2022, we outperformed Dashdot selected suburbs, outperformed the combined capitals by 126% and outperformed the combined regionals by 214%. And you can see in the June 2025 quarter, Dashdot selected suburbs outperformed the combined capital cities by 300% and combined regionals by 149%. If you look through this table, you are going to see that we've outperformed the combined capitals and combined regionals every single quarter since December 2022. We've actually outperformed every quarter since we started in 2019. But again, we only started creating this table in December 2022. And again, these are quarterly results. So this is the annual growth in median house price. So this is the looking back over the previous 12 months. So the performance metrics that we've been able to achieve in Dashdot have been pretty outstanding. And here's just another view of those numbers as well. This is it in graph format. So you can see the top line there in teal, that's Dashdot selected suburbs. And you can see the combined capital cities is the blue line, and the orange line is the combined regionals. And you can see over since is that since January 2023? Anyway, that's another point of view to look at it, that you can see that we've consistently outperformed both combined capital cities and combined regionals at the suburb level. Now, one of the things that's interesting is that at the property level, we typically outperform the suburb averages, and that's because we select the right properties in those suburbs as well. Because you could, and so we tend to have a few percentage points higher in average property growth in those locations because we select the right properties in those locations. So not only do we get the premium on selecting the right locations, we get a premium on selecting the right properties. And part of the way we do that, by the way, is that we have an extensive and unbeaten off-market network where we get about 75 to 85% of our properties off-market as well, which is just a little byline. So that sets us up for the comparison of the performance between both Bitcoin and Dashdot real estate. Gabby, you got anything to add?
Yeah, Goose, why did you feel like we needed to include all of that information? Because it was a lot. Like you and I are obviously very proud of the results that Dashdot's able to get, but why did you feel like it was important to showcase that amount in this conversation?
Yeah, it's a very good question, and thank you for asking me. And I'm going to rely on you keeping me on a straight and narrow, because I'm just going to be wonking out on numbers otherwise. So the reason I thought that was important is because one of the arguments from Bitcoiners broadly is that Bitcoin outperforms real estate, and so therefore you should just buy Bitcoin. And if you just looked at Bitcoin growth, and if you just looked at the national average, property price growth, like if you look at the national average, the median house price growth over the last 12 months, you would say something like, well, and I'm just plucking some numbers here, but you would say, well, in the last 12 months, Bitcoin grew by 100%, and the median house price growth in Australia in the last 12 months was 5.2% or whatever the number is. Therefore, screw housing, buy Bitcoin. But it's not that simple, right? And so even when you apply leverage, if you only bought the average property in Australia, then you would get significant underperformance, I think, generally in your portfolio. And what we want to do is we want to seek alpha. And so in order to, number one, show that there's a difference between buying the right properties in the right place at the right time, help everybody else to align to the lens with which I view real estate, which is not as some aggregate glob of property that is the national average, because that's not how I see it. And also to give some credence and background to the assumptions that I'm going to be showing that we've used when we've calculated the real estate portfolio performance versus a Bitcoin portfolio performance. And I think that's very, very important. And so me going through those numbers was not like just showboating, like, hey, look at all of our numbers. It's very important for you to understand the lens with which we've created the assumptions for the property portfolio that we're going to use to compare against a Bitcoin portfolio in just a moment. Does that make sense?
Perfect. Yeah. No, cool.
Awesome. Let us know in the chat if you are still alive. It's great. I think people are engaged. Let us know if you guys are alive and enjoying this as well. So let's go through some financial performance assumptions. And guys, this is where it's going to get really wonky. Okay. So if you thought that I just read through a whole bunch of numbers, and if you thought that was a lot, strap in, because we're about to get way wonkier. Okay. So
it's a wonk warning.
Yeah, it's a wonk warning with an O.
No, wonk warning. I need a sound effect. I'll make a sound effect. I'll get AI to make a sound effect.
All right, perfect.
Sound like Lost.
What I'm going to talk about now are the assumptions. So I built a DCA model. DCA stands for dollar cost averaging model. So I built a DCA model for Bitcoin, and I'm going to talk through the assumptions that we've used. Now, as I said at the start, you could change the assumptions and you could change the outcomes. Okay.
Yeah.
And so what we've used is an assumption that the average annual growth rate of Bitcoin declines from 50% to 25% over the next 10 years, or actually and then further. that growth rate assumption has been taken from Michael Saylor / MicroStrategy's Bitcoin 2024 model, available on GitHub. And I wish that I could more easily toggle my share screen. Is there a way to actually more easily do that?
If you toggle to the next tab, and then it should say share this tab.
No,
instead.
it's not a tab. I need to.
Don't know.
I'm just going to stop and I'm going to reshare just really quickly because I want to show you where I've taken this from.
Cool.
Oh wow, what's happening here?
Is that 50% to 25% decline? Is that like a linear decline over the next 10 years?
I'm trying to share my screen. So can you make it come up, please?
Yep.
Okay, so this is actually, so Michael Saylor and MicroStrategy released this really interesting model, and you can download this model on GitHub if you want. Just search for MicroStrategy Bitcoin 24 model GitHub, and you'll find your way there. So I've actually used the assumptions that Michael Saylor put out in here. Now, why? I think he's pretty based, right? So there's a million ways you could look at it. And in fact, if you go and do some research, you'll actually find that the consensus view is that, there's a variety of consensus views. Like some people think that the average compound annual growth rate of Bitcoin over the next 10 years is going to be 16 to 17%. Other people think it's going to be like 40% I don't know, right? And so what I've done is I've used this as a base case to build it off. And Michael Saylor is the largest. Michael Saylor and MicroStrategy, or Strategy B, Strategy as they're called, they're the largest Bitcoin holder on the planet. I think that they have done some pretty robust modeling to develop their point of view. And so I'm using this as the kind of base case. And you guys can go download that as well. Now, one of the, I'm really struggling with the sharing this. Okay. Sorry, guys. I think I might have discovered a new way to share. Okay, cool. Yeah, okay. So that's less good, but that's fine. So the growth rate assumptions are taken from Michael Saylor MicroStrategy's Bitcoin 2024 model. It's available on GitHub, and it's smoothed out to absorb the 50% annual average volatility. Okay, so there's a volatility rate in there, and that's smoothed out in the averages. And it's starting with $150,000 AUD in January 2025 at a Bitcoin price of $169,000 AUD, and then DCAing 5K a month after that. So what we're going to do now is we're going to have a look at the DCA model that I built. Okay, so you can see here in column A, this is the date, starts at 1st of 1st, January 2025. And it starts with an annualized growth rate of 50% compound annual growth rate. And then what I've done is I've smoothed it out on a monthly basis because we're doing monthly dollar cost averaging. So I smoothed it out on a monthly basis all the way down to 25% by January 2035. Okay. Then actually goes to 22.5% by the end of 2035. Now, what we've done here then is we've actually then got the monthly growth rates. And then, so we've started with a Bitcoin price of 169,000 in January 2025. And I had to pick a start point for this, by the way. And I figured it was easiest to start in a complete year. And the starting invested capital here, we've got a column in column H is the invested capital is $150,000. And then we've added $5,000 a month to the total invested capital in this column here. And then we've got a portfolio value. So you can see that what we've done here is we have dollar cost averaged $5,000 a month. So we start with $150,000, which bought us 0.887574 Bitcoin at 169,000 in January 2025. By December of 2025, so that is 12 months. So January through to December, we have invested a total of 205,000. So that's 150,000 plus 11 times 5,000 because you've invested 150,000 in the first month, gets us to 205,000. That means by December 2025, we have 1.155382 Bitcoin at an assumed average value of $243,500. $514. Now, that is not, by the way, a price prediction. What we've done here is we've taken the diminishing return and we've smoothed it out over time. And so what I'll do now is I will switch back to the deck. By the way, does that make sense to all of you guys? Because I can go into that in more detail, the dollar cost averaging model. If you guys need to see more detail on that, just let me know in the chat. I can go back into it. I'm just mindful that sharing a spreadsheet on the screen is a great way to make a lot of people's brains switch off. So rest assured, it has been calculated in a pretty significant way. So the way that we've done this as well is I've tried to show this as a diminishing return rate from 50%, you see on the right-hand side of this graph, down to 25% in 2035, and actually goes to 22.5% by the start of 2036. Bitcoin's price starts at 169,000 AUD and goes up to nearly 5 million by 2036. Or in fact, let me just quickly check my numbers in here. By December 2034, it's an assumed price of $3,981,796 in AUD terms. So the thing about this is Bitcoin has volatility, right? And so what we need to account for is that these averages have been smoothed out to kind of take out the average of the standard deviations of volatility. Bitcoin has historically or typically had a 50% annualized volatility rate. So you can see at the top of this graph here, it says Bitcoin price volatility bands with a 50% volatility annualized versus annualized growth rate. And so it shows here the solid orange line in the middle is Bitcoin price plus 2 standard deviations to the upside and 2 standard deviations to the downside to show the variability potential in price. So it could be, there's a significant variability potential in price over that time. And it shows the declining price growth rate as well. Now, what I did just to make it a little bit simpler is I put that into a log scale to kind of show how the price over time, combined with the growth rate actually creates an asymptoting curve. And that's a curve that actually flattens out as it doesn't go up in an exponential fashion. It actually flattens out. If you actually take it and look at it on a logarithmic scale, because of the declining growth rate over time, it doesn't keep just going steeper and steeper and steeper. It actually smooths out and starts to flatten out over time. So does that all make sense to you, Gabby? Am I explaining this in an appropriate fashion?
Yep, got it.
And so what you can see here, this kind of gives us a better point of view on the standard deviations to the upside and the downside. So if we imagine here at the start of 2025, that's 169,000. We get to 2030 and we're pretty close to 1 million. But hey, what if we're not 1 million? What if we're 1.5 or what if we're $600,000, right? So there's a potential of standard deviations in here. And so this solid orange line that I put on there. By the way, this is not mathematically imputed. I just drew a squiggly line. I'll be honest with you. I just drew a squiggly line. The point here is to show that the price movement of Bitcoin may not follow the smoothed out average, and it may oscillate within a 50% to 100. So if the average volatility is 50% annualized, that means that one standard deviation is 50%. But it could go as high as 2 standard deviations because you would need to take the average, means that you could also then double that to get to the outlier, right? So you could have as much as 2 standard deviations from the average or from the mean, and that could be the price. So price volatility may actually not follow the solid blue line path, but may oscillate around that. But we've taken the average out, so that should give us a kind of a reasonable point of view on Bitcoin price over the next, say, 10 years. Making sense so far?
Yep.
Okay. So what that means is that this is a simplified version of the DCA model where I've kind of collapsed everything down. So what that means is that in year 1, you would have invested $205,000 and then $5,000 a month, being $60,000 a year, every year for 10 years. So 2025 to the end of January 2025 to December 2034. So that means that over that period of time, you would have invested a total of $745,000 by December 2034. Mm-hmm. And if the Bitcoin price model holds true, the Bitcoin price by 2034 would be $3,981,796. and your Bitcoin holdings would have gone from 1.1554 in December of 2025, maybe that could have been January, that's fine, to 1.8148 in December of 2034, which would give you a total portfolio value of $7,226,242 off a total cumulative capital invested of $745,000, which would give you a return on invested capital of 869.97%. Does that make sense?
Nice. Yep.
Okay, so this is a built dollar cost averaging model that kind of gives us a point of view that if the growth rate of Bitcoin declines from 50% to 25% over the next 10 years on an averaged basis, discounting or smoothing out the volatility, then, and if we dollar cost average consistently over that period of time, then we could potentially get an 869.97% return on invested capital. Now, the interesting thing about that is that assumes that you never sell anything and you dollar cost average consistently the same amount every single month for 10 years. So all of this, everything that we're going through, is subject to people actually doing the thing. Just because you can doesn't mean you will, right? Are you really actually going to do that? You're going to do that every single month. Now, if you don't, if you skip a couple of months, then your results would be different, right? So necessarily that would change the calculus. Guys,
and this is
let us know in the chat if this is making sense, by the way.
Was it 5K a month?
5K a month, 60K a year.
Yep.
Exactly. So let us know in the chat if this is making sense. If I'm going too fast or too numbers oriented or anything like that, please let me know. We have some non-number stuff coming up a little bit later as well. But I think it's very important to compare the financial performance of these two assets. Now, by the way, the growth rate case that I've used may be bullish or it may be bearish. The thing is, we don't know. You know, if you know, like that puts, by the way, that puts over that 10-year period, the average compound annual growth rate over that 10-year period would be 36.22% if you averaged it out. If you took the 50 down to the 25, or actually, if you took the 50 down to the 25, it would be 37.52% average compound annual growth rate over that 10-year period. You know, some people are saying that it could be higher than that. Some people are saying it could be lower than that. I actually don't think it's too far off from my sort of personal opinion on where that can be, which is why I also have a pretty strong point of view on Bitcoin being a good asset class to invest in. But let us know in the chat if this is making sense, guys, because again, we're here to do this with you, and I just want to make sure that I'm not going too fast. And I've spent a lot of time preparing for this. I would hate to not have it land. So if you need me to slow down or speed up or skip stuff or go deeper, then just let me know, because otherwise, if it's not useful to you, then it's been a waste of my time. So please let me know. So
I think, I just wanted to say, I think where we've gotten to with the ROIC, because I think that's an important thing that will compare with the two asset classes over time. That helps to kind of normalize them, because they are very different assets just generally. So I think where we've gotten to with that ROIC, I think that's helpful as a like net result of the potential here. Yeah.
And also we're going to compare the ROIC, and we're also going to compare the portfolio values a little bit later, because those two things are really important, because the return on invested capital on a year-on-year basis can really transform the total returns. Okay, so let's move on to real estate. So here are the assumptions we're using for the real estate version. I just need to quickly check something. That is, okay, we're still good. So the assumptions we're using for real estate are the same capital contributions. So starting with $150,000 AUD in January 2026. Now, it doesn't matter as much that it's January 2026 in the portfolio growth plan model. The reason it was 2026 is because it was harder to model historical properties in the PGP, and it doesn't really matter, because what we're actually this is easier to think of as year 1 through 10, right? But we started it as January 2026. So starting with $150,000 AUD in January 26, dollar cost averaging $5,000 a month. After that, all properties are modeled with a 4.5% gross yield. The annual growth rates per property that have been modeled are as follows. Year 1, 22%. Now, if you remember, that's a little less than the average year 1 capital growth that our clients have achieved, and we've bought over 2,000 properties. Now, if you take a 60% growth rate over 3 years, and if you assume that the first year is 22%, then what that actually means is that, and if you then smooth that out on a trend rate, that actually means that year 2 is 17% and year 3 is 12%, 17.02% and 12.04%. Year 4 goes down to 7.06%. Now, what we have done in this model is we've just assumed that from year 4, 7.06% carries forward. Now, some people might be saying, like, whoa. Okay, right. We can get around the idea that the first 3 years you're going to have 22%, then 17, and then 12%, and even year 4 being 7%. But is it reasonable to say that 7% is going to carry forward on a long-term basis? No, but there's 2 things that I would say to that. And by the way, myself and Andy Bernardos, if you've been watching the podcast, you will have seen him come on a few times. He knows as much about portfolio strategy, if not more, than I do now. Like, he spends so much time thinking about it. He's been integral in the development of the portfolio growth plan. Like, he knows his shit, basically. He and I really spent a lot of time on this together this week, pressure testing our thinking around these ideas. And so what I would say to the 7% on an ongoing basis on a calculation is 2 things. Number one, cycles are getting shorter. And so what we are seeing is that over a 10-year period, it is more likely that you would see a second kind of growth spurt than in the past. Like, the cycles seem to be getting shorter. Locations that we're buying in 2019, we're now buying again in 2025 because we're starting to see them pick back up again. So the probability that over a 10-year period, you would see another growth spike is higher. Number 2, I think that the last 5 years of optimal growth rates across the country, we'll see a mean reversion in general, which may mean we see slightly higher growth rates over the next, say, 5 years or something like that. And number 3, is that we haven't, and you'll see the note there at the bottom, we haven't modeled active selling in the portfolio, which may be required, and in doing so would create similar, if not better, returns. So if you imagine that you had a property and you owned it for, let's say, 5 years, and in this case, year 1 growth is 22%, year 2 growth is 17%, year 3 is 12%, year 4 is 7%, year 5 is 7%, then you sold it, and then you bought another property, and then you got those same results again, that would actually give you higher than a 7% average growth rate over a longer period of time. So rather than overcomplicating it with selling, putting all these selling stuff, we just said, look, we can smooth that out and we can rationalize it.
Yep.
Now, we've also created some assumptions in there based on interest rates. So we've assumed a 2025 interest rate of 6.5%, a 2026 interest rate, maybe I got those years slightly wrong. Anyway, 6.5% to 5.5% to 4.5% to 3.5%, and then the ongoing interest rate of 3.5% on an ongoing basis. So that does assume that in the future, interest rates are going to go down. But we don't think we've approached that aggressively. We haven't said, hey, they're going to go to 2% by next year. We've said over the next few years, by 2028, we should get down to about 3.5% interest rate, and that would be the interest rate on an ongoing basis. Now, could that be wrong? Yes, but it could be wrong to the upside, and it also could be wrong to the downside. So there could be lower interest rates, or they could be higher. We don't know. But I think a fairly consensus view is that interest rates probably do need to come down, and inflation is coming down, and so I don't think we feel that is a reasonable point of view to take when constructing this comparative model. So those are the assumptions that have gone into creating the portfolio growth plan. Does that make sense so far, Gabby?
Yep, it does.
Okay, great. So let me actually show you the plan that we built. Stop sharing that one and start sharing.
I'll just add, I think it's important and awesome that you've really pulled apart all the assumptions that go into this, because I think people who, like, you're a skilled investor, and I think people, if they may not be as like spreadsheety as you are, don't realize that a lot of the models are only as good as the assumptions that go into it. So like you said at the start, the outcome is going to vary vastly based on the inputs that you put in as the assumptions, and it's like there needs to be education that goes into like making those assumptions, and that's where a lot of the research comes in, particularly like growth rates and interest rates and everything as well. Yeah,
totally. And look, the quality of your assumptions is going to dictate a lot of things. Like, because if you just said, hey, what's the long-term average growth rate of Bitcoin? And you might say, well, since the start, it's 100% CAGR. Okay, well, I'm just going to forecast that it's going to be 100% compound annual growth rate into the future. Well, that'd be dumb, right? Like, and if you say, what's the, if you just kind of like take these very uninformed points of view, you could really stuff this up. And part of the reason I think this is a really interesting discussion, by the way, actually, do you want to just stop the screen sharing just for 1 second? Well, part of the reason I think this is a really interesting discussion is because, like, in the Bitcoin space, and anyone who's been watching this channel knows that I'm pro Bitcoin, right? So like, I'm a big advocate of Bitcoin. But in the Bitcoin space, there's this narrative that Bitcoin smashes real estate, and it's based on some assumptions, and those assumptions are things like, well, real estate grows at like 6% a year, and Bitcoin grows at whatever 50% a year or 70% a year or whatever. Therefore, don't be stupid. And it's like, well, the quality of your inputs is going to dictate the quality of your outputs, which is also how we've been able to get outsized returns in real estate, because the quality of our inputs dictates the quality of our outputs. And so unpacking all of this and really thinking about what assumptions are being made and where and how do we think about where we are now? How do we think about where we're going? Actually helps to shape it. That's why it's actually an important discussion, so that we're not just taking uninformed views and slapping them together and hoping for the best. So let's jump back into the share screen. Okay, so this is the portfolio growth plan we built. We did several versions and iterations of this plan to finesse through it. We feel like this is an achievable plan based on the assumptions that we've got. So starting with 150 grand, $5,000 a month savings rate, right? And we've assumed that we would use all of the different financial jujitsu that you've heard us talk about on this channel. We would use trusts and this and that kind of stuff, and we would move stuff so we'd do the work to make this work. The point here is that over a 10-year period, from January 2026 through to 10 years later, so 2035, we would end up with a portfolio with a net equity value of 11.5 million over 16 properties, and actually producing a bit of cash flow in the end there as well. So for a lot of people, they might think that this is audacious. And Andy and I spend a lot of time thinking about this. Like, is this too audacious? So there was actually an even more audacious version that we actually couldn't justifiably work out why it wouldn't work. But we said, hey, look, that might be a little spicy, so let's tone it back a little bit. Basically, this is like buying 2 properties a year consistently over a period of time. So there's a bit of a gap between the first one and the second one. And then it's basically 2 properties a year on an ongoing basis, which, if you are structuring your finances correctly and using the appropriate structures and using the appropriate lenders, is actually achievable. Because what you'll also notice here is that with a $60,000 a year savings rate contributing to this, which is covering things like negative cash flow and or deposits, right? So if you've got $23,000 negative cash flow, that's going to come out of the 60 grand, but then also the surplus is going to go in to cover other things like deposits or maintenance or whatever. So it's all covered in here as well. But the idea here is the negative cash flow never exceeds the savings rate, not even by a long shot. And so you have a serviceable capability to be able to support the negative cash flows from the portfolio on an ongoing basis. Bearing in mind, all of these properties are modeled at 4.5% yield. So we think we've been fairly conservative on that front as well. So this appears to be achievable. Now, just because you can doesn't mean that you will. And so a lot of people, maybe you can't save $5,000 a month, that's fine. But even if you could save $5,000 a month, you may not have the commitment to actually go through the process to go and buy 16 properties in 10 years. Now, we have a lot of examples of clients that have hit numbers like this. Now, I just saw that Justin and Steph, 2 of our clients, they have just signed up for property number 7. And I would guess they've been with us for 4 years, maybe 3 years that they've been with us. Property number 7, they're buying. We have another client, Tony. He bought 8 properties in 4 years. We have Charlie, who I believe is in the chat. I think he bought 10 properties, maybe more. Geez, I lost track, actually. Charlie, I don't even know how many properties you bought, man. It's a lot, but it was like 10 properties in a few years, in like 3 years or something. So the idea is that this is actually doable, and we actually have a strong track record of seeing people do these kind of numbers. Daniel K, he's just signed up for, I don't know, property 1,072,000 or something. Like there's lots of clients that are actually getting these kinds of results. So we actually sat down and pressure tested our thinking around this, and we believe that this is sound and robust and achievable. So this is the plan that the numbers have been built off. It's gone through the entire process of being built out as a portfolio growth plan, so none of this back of the napkin stuff. And this is how we've formed the assumptions for the comparable analysis. Make sense?
Makes sense.
Okie dokie. One moment. So now let me share back again. This share function is not very good on this. Okay. So that was the portfolio growth plan that we built these assumptions off. Now, using the same capital invested, so $150,000 in January 2020, January year one, and $5,000 a month thereafter, which gives us $205,000 in the first year, and a total cumulative capital invested of $745,000 in year 10, with the total number of properties bought it being 16. We would get to a total equity value of $11,529,564. A little bit of a formatting error there, but that's okay. But you'll notice here that the portfolio LVR, by the time we get to that point, is only 52% by the time we get to year 10. Now, this actually supports the thinking behind the ability to be able to do what we were talking about doing. Because in order to continue to borrow more over time, having a lower LVR does actually support that capability. So if you're in a position where you're utilizing trust structures and, getting creative with how you're approaching this, then, and also you have enough savings to be able to support the serviceability of the negative cash flow and the debt and all of those kind of things, plus you have a low LVR in your portfolio, we don't think this is an unreasonable perspective to take, right? Is it aggressive? Yes. Is it more aggressive than most people do? Yes. Does it mean that it's not doable? No, it doesn't mean that at all. It just means that most people don't have the commitment to kind of move this kind of in this kind of way. So what we've done is we have not included any negative cash flow. And the reason being, negative cash flow gets absorbed as an operating expense. So out of the $60,000 savings rate, if you had $25,000 of expenses, well, that would come out of the $60,000. We have included positive cash flow because that's an operating profit, right? So that would then add to the value of the equity that you've got as well. And that forms part of the return on invested capital. So by year 10, the total portfolio position would be $11,609,908, or a return on invested capital of 1,458.38%, which is pretty crazy, right? Does that make sense? Are you excited by that, Gabby? Do you go, wow?
I think I'm a little bit biased because because I see the results that the clients get inside that I'm like, yeah, it makes sense. It's like, it's insane when you compare it, particularly obviously comparing it with Bitcoin in this example. And obviously like leverage plays a huge role in that result, right?
Yeah, 100%. We'll get to that in a second. Look, I can say, I can say firsthand that you and I, we did something like a 13 or 15x on our capital in 4 years in real estate.
Yeah.
And we didn't do anything.
No.
We didn't we replaced a roof once, but we didn't do anything spicy. We didn't do anything creative. We just bought houses. And it was either a 14 or a 15x in 4 years. So to say that it can be done, like I look at this and I go, it's super achievable. So now we're going to do a side-by-side comparison in these numbers. And again, I'm struggling with this, the sharing.
It's all good. There's lots of tabs.
Yeah, I've got a lot of different tabs open. So, okay. So what we've done, what I've got here is a side-by-side comparison between and this is these are all the same numbers that I just showed in the slides there. So you can see here that the real estate return on invested capital is 1,458%. The total portfolio position by year 10 is $11,609,908. If we compare that with Bitcoin, the return on invested capital by year 10 is 869%, and the total portfolio value is $7,226,242. So if we compare real estate versus Bitcoin portfolio value, we can see how they perform on a year-over-year basis versus each other. Now, what's interesting here is if we look at the ROIC in year one for real estate, it's actually a negative return on invested capital. And you might be like, hang on a second. I thought you said that the average was like 73% return on invested capital in the first 12 months. Now, what's interesting about this is in year one, we modeled a purchase of let me see if I've got the workings here. The purchase of a $680,000 property. Oh, that's not going to show up very well. We purchased a $680,000 property in January. You don't start accruing the growth until February because you buy it in January and start accruing the growth in February.
Mhm.
And anyway, the net total is only count 10 months of the growth. And also in year one, we leveraged some of the equity plus the savings to then go and buy another property. So we've actually taken, and that property had been purchased but not yet settled, and settles in year two. So you've actually sort of got two purchases and sort of unwinds it a little bit there. That's why that's a negative in year one, just functionally how it kind of played out. So, but what you can see here is on a value basis, based on the same financial inputs, you actually can see that Bitcoin beats real estate in the first 2 years, and then real estate beats Bitcoin in each subsequent year by 30%, 60%, 74%, 77%, 76, 74, 70, and 61%. Now, that is a median outperformance of 65%, and that's an average outperformance of 47% on portfolio value. So that's basically how much actual wealth have you created over that period of time, which is super interesting. Super interesting. Now, if we compare the return on invested capital, which is another great way to consider this, you can see that Bitcoin beats real estate by greater amounts in the first 2 years, but real estate still beats Bitcoin in 8 out of the 10 years, with a median return on invested capital outperformance of 83% and an average outperformance of 50%, which again is pretty interesting. Now, I know what you're probably thinking. You're probably like, yeah, okay, but have you been a little bit too spicy with your assumptions in real estate? So I created a discount rate version of this table as well. And so I assumed a discount rate of 30% on both the ROIC and the total portfolio position, so the total portfolio value. So we took the original values and we discounted them by 30% all the way through. And even then, you would still see that real estate beats Bitcoin in 7 out of the 10 years on a portfolio value basis, and still 8 out of the 10 years on a return on invested capital basis. All right, so what if I change the discount rate to 35%? Okay, well, Bitcoin's winning for 3 of the years, real estate's winning for 70 of the years in both cases. What if I change the discount rate to 40%? So that's assuming 40% less than the original value. So we've gone from an end state value of 11,609,908 to 6,965,945. So you can see in this case, Bitcoin sort of catches up a little bit at the end, but that's a very heavy discount rate. That's assuming that we've got it wrong by nearly half. That's a 40% discount rate on the assumptions we've made. So that means that Bitcoin wins in 5 of the years on a portfolio value basis. Real estate wins in 5 of the years, and on a return on invested capital basis, real estate still wins in 7 of the 10 years, which is crazy. So even if we go to a 50% discount rate, okay, that makes it a little bit more like Bitcoin wins, right? But you've got to assume.
Yeah, you've got to get it very wrong.
Yeah, you've got to get it pretty wrong. And given that we do this for a living, and given the amount of time spent on this, I don't think that I've got it 30% wrong.
Yep.
So, maybe 10% wrong. But what's super interesting here is you take the best performing asset in the human species, and then you put it against real estate, well-selected real estate, structured correctly in a strategic fashion, and you get outperformance. And this is the thing that people don't get. Like this is why it's so interesting to me. And I'm a Bitcoin bull. I'm like, I freaking love Bitcoin. I think it's awesome. But you have to be able to compare these two in this fashion and go, okay, well, how does this actually land? Guys, let us know in the chat what you guys think of this. Is this interesting to you? Have you guys have you seen this before? Like, are you blown out of the water? Or are you just like, yeah, it makes sense. when your real estate was going to win? Did you think Bitcoin was going to win? Because we haven't finished yet, but I'd be keen to know your thoughts. So that's the side-by-side comparison. But go on.
Just quickly, I don't think it would have been this obvious that real estate would come out on top at this stage, like on a pure financial basis.
Totally.
Yeah, it is interesting.
Yeah. It's so surprising because like you take this slow moving, boring asset class, and it can outperform Bitcoin, the best performing asset in the human species, right? And you're like, what? How does that work? So let me explain how and why that works, though, because it is in fact it is all of the things that people say is wrong with real estate that actually give you the ability to outperform Bitcoin. It is the fact that it is slow. It is the fact that it is not very volatile. It is the fact that it is low risk. That is exactly why you're able to leverage it in a way you're able to leverage it and then start to amplify the returns. Because if you just compared, let me share. I'm going to share in a slightly suboptimal way. But if you just compared a standalone comparison, so if you just bought one Bitcoin in January 2025 for 169,000 AUD, and if it reaches what we have in the dollar cost averaging model of 3,981,796 AUD per Bitcoin by December 2034, you would have made a return on invested capital of 2,255%, or a return multiple of 23.55x. Now, the reason that is higher than the dollar cost averaging model is because you just put the money in once and you didn't touch it. If you continue to add money over time, then your return on invested capital is going to go down because you're continually adding. You're only getting the returns off the capital you've invested, right? So you would have a higher total return, but a lower return on invested capital. And that's based off the dollar cost averaging model. So if you just bought one Bitcoin and just did nothing, and that's it, then your returns are actually going to be pretty obscene, right? If you bought one property, based on the modeling we did, if you bought one property for $680,000 with a total purchase capital required of $150,000, in 10 years, you could potentially achieve a 656% return on invested capital, or a return of 7.56x. Now, I actually did this actually mocked this up in an Apex report as well. So I went through, I'm not going to bore you with all the details here, but I modeled all of this out in an Apex report. And I said, okay, cool. What would this look like if we just bought one property, not dollar cost averaging? We just bought one property, 150 grand in. Where do we get to? We get to a 656% return on invested capital in 10 years' time. And so why is it then that the difference is so severe between real estate over 10 years versus Bitcoin over 10 years? And it's because the power in real estate comes from leverage and being able to leverage equity multiple times to compound the overall return on invested capital. Because you put money in, but then it's growing. You're able to leverage the equity out of one property and then use that as capital to buy another property. And you're able to still do that whilst actually lowering your LVRs over time. So it is actually the nature of real estate that gives you an advantage. It is the fact that, the safest houses analogy holds true. Banks love it because it's boring and slow and predictable and all of this kind of stuff. And you can use that to your advantage to actually get better than Bitcoin returns if you know how to play the game. Sweet. So, sorry. So we're going to move on now to a comparison scorecard here. And this is actually where we're going to start to share some of the non-financial stuff side by side as well. Now, one of the differences, by the way, is the amount of work that's involved. And one of the things we miss out on this scorecard is that in order to achieve these kind of results, like 1,458% return on invested capital versus 869% return on invested capital, it's much more active. There's a lot more work involved. But that is the premium that you get from putting in the work. And so if your goal is to make more money and you're willing to put in the work, then you can get to that outcome. This is by the way, none of this is meant to be just showboating like, look at real estate, it's awesome. I just think it's important that we have a well-rounded point of view to actually understand that you actually can get better than Bitcoin returns in real estate. So let's have a look at a comparison scorecard. So we looked at it across how many vectors was it? 16 vectors? No, yeah,
16
vectors.
I think.
Yeah. So we looked at Bitcoin across Bitcoin versus real estate versus Bitcoin across 16 different vectors that you should be able to see on your screen right now. So number one was liquidity. Real estate has low liquidity. Selling a property can take months. There's transaction costs, legal processes, yada, yada, all that kind of stuff. Bitcoin is highly liquid. It can be sold almost instantly, transferred instantly, instant global settlement, all of that kind of stuff. So on a liquidity basis, Bitcoin wins. So that's a score 1 for Bitcoin. Volatility, real estate wins. Stable values, there's less temptation to panic sell. Partly, again, this is where, like, one of the downsides, lack of liquidity actually equals a lack of volatility. And that's actually one of the reasons you can get 90% leverage on real estate, which is crazy. Whereas Bitcoin has a high volatility. It's got an average vol of 50%. With add a standard deviation onto that, and you add to 100% as well. So real estate wins on a volatility basis. Risk profile. So real estate risk profile is low. Yes, you could potentially have market downturns. There's interest rate changes, vacancy, maintenance costs. But theft of property requires a pretty significant amount of fraud or illegal seizure. It's pretty hard to steal a house, right? And there's fairly stable and predictable laws. Victoria being the slightly outlier there, but generally speaking, everyone understands what real estate is. Bitcoin, though, is a lot riskier. Yes, there's price volatility, but if you don't sell, then it doesn't matter. There is regulatory risk, but there's custody risk, right? So you could very easily lose your wallet. You could store your Bitcoin on an exchange. The exchange could get hacked. You could have your Bitcoin stolen. You could lose your keys. There's all kinds of different ways where you could have your Bitcoin either stolen or lost. And that is a risk, right? And if you're relying on Bitcoin to live off Bitcoin, and it does have a lot of volatility, then you could go from having a lot of money and feeling quite affluent and safe, then the Bitcoin price could go down a lot, and all of a sudden that your value, your net worth has gone down a lot, and then you have to deal with that. So there's a lot more risk in Bitcoin from that perspective. I don't think Bitcoin has a risk of going to zero or something like that. I don't think it's like a risky speculation. It's just got other risks associated with it. But anyway, real estate wins on the risk profile front. And Robert has just put in the chat, I love illiquidity because I can't sell easily on an emotional whim. And that is actually one of the
very true.
It's actually one of the points in here, actually, which we will get to in a moment. But anyway, we'll get to that. But that's actually one of the upsides is you can't. Oh yeah, so volatility. Yeah, you can't panic sell real estate. You can call a real estate agent in a panic and say, I want to sell my house, but then it's going to take you bloody months to do it anyway. So you can't panic sell real estate.
Yeah, even if you try to sell it very quickly, you cannot.
Yeah, exactly. So, and that's got upsides to it as well. So risk, so cash flow and yield. So real estate does produce yield. It produces reliable rental income, and that rental income often grows over time. Bitcoin does not produce yield. Doesn't have any built-in income creation framework unless you take risks like lending it out and doing all of that kind of stuff, which introduces counterparty risk, and it's not a good idea. Purchasing costs.
Yep.
Do
you want to keep? I've got a question about the cash flow, but it's more of a talking topic, so I don't know if we want to pause or you want to keep going through the.
Let me smash the table out, and then we can talk about it.
Yep.
Take a note of it because I'd love to talk about it. So cash flow and yield. So real estate produces yield. Bitcoin does not produce yield. So real estate wins on that front. Purchasing costs. Real estate has high purchasing costs. So stamp duty, professional services, inspections. Bitcoin has very low purchasing costs, basically just exchange fees. Bitcoin wins. Affordability, low for real estate. The cost to get into the market is probably north of $100,000, right? Like, maybe you could get away with a little bit less, but generally speaking, it's about 100 grand or more to get into the market at the moment, which means the barrier to entry is very high. Bitcoin, the minimum purchase is 1 Satoshi, which is, can't remember whether it's $2.50 or $5 at the moment. But I'd imagine that the smallest value you could buy on an exchange is about $5, which allows very low barrier to entry. So Bitcoin wins on that front. Costs and maintenance. Real estate has ongoing upkeep, repairs, management fees, wear and tear, tenant misuse, floods, natural disasters, all of that kind of stuff. Bitcoin doesn't have any physical maintenance required and no physical degradation, doesn't in any way, shape, or form. So Bitcoin wins on that front. Portability. Real estate has a fixed location. You can't move the asset. You can't pick it up and take it somewhere else. If you own a property in Victoria and you don't like the legislation, you can't move it to New South Wales. It's there, right? Whereas Bitcoin is infinitely portable. It can be carried across borders digitally, easily. You can carry your seed phrase in your head. It is infinitely portable. So Bitcoin wins on that front. Verifiability. Well, real estate's ownership is verifiable via land registry. It's centralized, but it's also a physical asset. So it's very easy to verify in the real world. Is there a house there? You can just go there and be like, is that a house? Yes. I can verify that the house is a house. It's because it's a physical, tangible asset that you can actually go and look at. In fact, it's easier to verify your house than it is to verify gold. Like, because even if you went to a gold vault and said, show me the gold bullions, you'd still need to melt it down, recast it, so verifiability of real estate is actually pretty good. The verifiability of Bitcoin is obviously great because it's verifiable on chain and it's decentralized. So that's a draw between Bitcoin and real estate. Leverage and bankability. So real estate, you can borrow up to 90% LVR, which amplifies your returns, and it's a recognized collateral for loans, which is good. Bitcoin lending is got limited availability. Margin carries liquidation risk. So if you try and buy Bitcoin on margin, you could, because of its volatility, you could get wiped out basically. It's rarely accepted by mainstream lenders. Now there are some Bitcoin backed loans coming out and Bitcoin lenders and stuff coming out, which seem to be reputable as well. So there is becoming more availability of that, but it is still not the same as real estate. So real estate wins on that front as well. Tax benefits. So with real estate, you get access to depreciation, negative gearing, all of that kind of stuff. Bitcoin, there's not really any ongoing tax benefits. You still get the CGT discount though, which is important. So real estate wins on that front. Inflation hedge. So real estate hedges currency debasement locally, and Bitcoin hedges currency debasement globally, which I think is pretty awesome. So that's a draw on that front. Tangible value or utility. So real estate has a tangible value with utility, so shelter, rental. Bitcoin is a purely digital asset. So there's no physical use, right? So it's got no physical tangibility per se. It's it's digital in that sense. So that has downsides too. It has aside from the store of value, you can't. It doesn't serve a functional utility like shelter or anything like that. So real estate wins on that front. Inheritance and wealth transfer. So real estate's pretty straightforward. It happens all the time. I remember my granddad passed away, and the house was transferred to my dad and my uncle, and it was all pretty easy peasy. Whereas Bitcoin is actually a little trickier. In principle, it's simple. You just transfer it to the wallet, but you actually need to know where are the keys? Does everyone know how to use them? Have you set up an inheritance planning thing? How is everyone going to access your wallet if you see seed phrases in your head? It's actually, in principle, simple, but in practice, very difficult. And it requires a lot of complexity to set up an appropriate inheritance planning aspect of that as well. So real estate is the winner on that front. Financial performance on a standalone basis. And this is going back a couple of slides here. On a standalone basis, if you just bought one of each, one Bitcoin and one house, then Bitcoin would actually probably perform better than real estate. If you only bought one house and you didn't use financial jiu-jitsu and you didn't use leverage to leverage equity and go to other stuff and everything like that, Bitcoin would win. If you just bought one Bitcoin and just bought one house, then Bitcoin would actually win on a standalone basis. However, over a 10-year portfolio, if a well-constructed portfolio aggressively pursued could potentially deliver 1,458% return on invested capital over a 10-year period versus a solid Bitcoin DCA strategy could deliver as much as 869.97% return on invested capital over 10 years. Real estate wins. So of these 16 vectors that we've looked at, real estate wins in 9 and Bitcoin wins in 7. So real estate gets the edge a little bit on that front. If we added passivity, like purely passive in nature, and passive versus active, then maybe you'd add another point to Bitcoin, and maybe it would be 8 versus 9. But still, it's not a landslide in one way or another. It's like real estate comes out a little bit on top. What do you think about that, Gabby?
Yeah. I was just thinking there's a lot of these vectors as well that I think over time, because Bitcoin it's just kind of this year, past 12 months, developing a lot more of the frameworks and logistics, I guess, as related to, paperwork and legal and finance and things that make it, I guess, legitimacy is what I'm looking for in terms of it being a financial asset, whereas previously it's been a very underground asset that people chose to invest in, and people were like, what's this weird Bitcoin thing, crypto thing. It's
Yeah.
still like that for a lot of people. But I think as time goes on, a lot of these infrastructure things will come into place that make it more of an option compared to real estate. So like the even just being able to get leverage. Like right now, not a whole lot of options, but I imagine as the legitimacy of the asset class increases over
Yeah.
time, there will be more and more options that appear similar to.
I still don't know if it's going to be apples for apples though, because like what you're like with real estate. I mean, I think it'll take a long time for that to mature. Like I see what you're
Mhm.
saying, but I think it'll take a
Yeah.
long time for that to mature because, with real estate, if you bought a $500,000 property and then it goes up by, 20%, then and you
Mhm.
leverage 100 grand. I'm obviously oversimplifying it. Leverage 100 grand out, you go buy another property. You've still got property number one. You can go up by another 20%. You've
Yep.
bought property number two. It goes up. It goes exponential very, 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 very quickly.
Yep.
To get to a point where you're leveraging Bitcoin to go buy more Bitcoin, which then grows to leverage that to go buy more Bitcoin. I think that's going to
Yep.
take a really long time. And the
Mm.
part of the reason I think that's going to take a really long time is the level of volatility involved. Like
Yep.
you can't leverage it in the same way and the volatility may smooth out over time as well with the broader adoption, and we'll
Yep.
probably see volatility come down. But I think what you're suggesting is probably 10 years away,
A while
realistically.
away. Yep.
Yeah.
Yeah. Fair enough.
Yeah. So who do you think is the winner, Gabby? Because there's, and this is an open question, by the way, because real estate does, and by the way, in the chat, let us know who you think the winner is, because real estate can outperform Bitcoin financially, and based on a comparison scorecard, just pip Bitcoin at the post as well.
Mhm.
But it is active. And I think going back to kind of what you were saying earlier, it really depends on your goals and your objectives. And one thing I would say is, if you are an Australian and you are living in Australia, you're paying tax in Australia, you're participating in Australia, and you are not investing in real estate, I would really suggest you ask the question, what the hell are you doing in Australia? Like why are you there? because Australia has so many regulations, taxes, torts, constraints, constrictions, all of these kind of things, that the main thing that you would want to take advantage of is the fact that it's got the best real estate market in the world, particularly if you work with Dash and you buy the right properties in the right place at the right time. And so if you're there and you're not participating in that, then what the hell are you doing? Because you're getting eaten alive. But it does require more work. There's more effort. You've got to go, there's more paperwork, buying a property is harder and everything like that. And so the way that I kind of think about it is, and this is me personally, getting that significant level of outperformance financially is the premium that is required actually for the work that is required. Because if it was the same, let's just say you compared apples with apples, and let's say they both achieved the same return on invested capital over time, like 100% exactly the same, but one required twice as much work as the other. Well, then you'd be like, well, why would I do the one that requires more work? But I think that the significant financial outperformance gives you the premium that makes doing the work actually makes sense.
I think on that,
go on.
On that effort piece as well, I think that's a factor to, I don't know if it was a vector in that table, but something to consider at different stages in your investment journey. Because I think when you are earlier, let's just say it's your first property, because a lot of people, when they first learn about real estate, they might think about like doing renovations and things, and it's because they don't necessarily have a whole lot of capital to start with, but they have more of their own energy and effort, and that's the resource that they are willing to put into that investment. And I think as you grow as an investor and transition over time, it becomes like you have more resources in terms of money to invest, so you are less willing to put your time into things. So I think that is something that transitions over time, because I know you and I, very busy people, don't really want to, like you said, we put a roof on one property once, and that's the extent of our renovation history, because it's not something that we have such a high value on our time, and we would rather go the extra mile and try and learn how we can find other ways to get financial return that don't involve the effort. So for us, where we are at, the more passive the investment can be, the better. But that may not be everyone's journey.
Well, yeah. I mean, I think, yeah, I think it's a sound point, and I think that again, everyone needs to address as look at their own circumstances and work out what's right for them. I
Yeah.
think I think it's pretty wild though that you can with real estate beat the best performing asset class in the world, right? I think that's pretty wild.
Yeah, it is.
You know,
Yeah.
like and whilst there is stuff to do, if you work with a company, by the way, all of the numbers that we put in the portfolio growth plan, they include paying Dashdot's fees as well. So if you wanted to work with Dashdot, and you want to make it easier, because part of the issue with real estate is the amount of work required, but you can take a lot of that work off your plate if you work with Dashdot. And there's a link in the description and the show notes. There should be a link there that if you want help, if you're looking for a team or partner to partner with you in your building your portfolio journey or whatever it says there, you can click on a link and book in with the team. Because I think it's really important to know that you can make it easy. And that's actually what we tried to do with Dashdot is we tried to make it easy. We said, okay, how do we take this thing that is, I always used to say that real estate's the largest asset class in the world and it's the least understood. And that was the thing that excited me so much about it, was like, oh, this is a very opaque thing. How do we become more successful at that? And the proof is in the pudding. Our results have been getting better over time, not worse, which is not what should happen. And that's thanks to the exceptional team that we have around us. It's not that much to do with me or you. It's actually the team that are delivering those exceptional results. But also we've built a system that allows you to do it easily. And so if you can take the friction off the table by working with someone to put ease on the table, then, and also you can get better returns than Bitcoin or even similar returns to Bitcoin, that should be a pretty good trigger for you to want to move in that direction. That should be a pretty good trigger for you to say, okay, wow, okay, cool. Like Bitcoin is great and exciting. And I love Bitcoin, by the way, for all of the reasons you said. It's simple, it's easy, you don't need to think about it. It's kind of like, I just think about it as a savings technology. But I actually think about real estate. It's interesting. My point of view has shifted a little bit, that I see real estate investing as a make money technology, and I see Bitcoin as a saving technology. And so if I wanted to make money, then I would want to go and invest in real estate. And if I wanted to then save money, I would want to go put money in Bitcoin. That's kind of how I think about it. But it's just me.
Related to that, I was just remembering the question that I was going to ask about cash flow earlier.
Yep.
It's not a question, it's more just like an interesting topic to talk about, because I think both of these examples that we've shown and the metrics that we've compared has been portfolio value and ROIC, and both of those are based on asset value growth, right? So they're growth assets. But for a lot of people, particularly like with Bitcoin, HODL is the terminology that Bitcoin is used in terms of like hold it forever and never sell, but it also doesn't generate a yield. So how would you approach between these two assets in terms of thinking about actual cash flow for people to?
I think cash flow is overrated.
Yeah, but let's just say you I guess this is where portfolio mix comes in. Because if you just had Bitcoin, because there's a lot of people that bought Bitcoin 10 years ago that have got shitloads now, but they're never going to sell any. So they're cash flow poor on a day-to-day basis.
Yeah, but I think cash flow is overrated. I don't think you need cash flow. No.
What do you live off? Unless you sell.
So you live off. Yeah, you live. Well, yeah. You sell stuff, right? So think about it like this, right? So if you bought 1,000 Amazon shares, right? They've never paid a dividend, and you bought 1,000 Amazon shares for, I don't know, $1 a share, and then they became worth $100 a share, right? You would have, don't do public maths, a lot of money, right? And then you could sell a share from time to time to pay for the things that you need, right? And so so I don't think that so I think selling growth is actually can be more beneficial, because and the reason I say cash flow is overrated, right? Cash flow gets taxed on an income tax basis, right? So on a marginal tax rate basis, whereas CGT is cheaper than your income tax in most cases, unless you've completely stopped working, right?
Yeah.
So I don't know that people need to be as obsessed about cash flow as they are. I think it's actually reasonable to say, can I find high growth opportunities, even with real estate, right? So let's say you buy a property for 500 grand and then it ends up being worth, $1 million, and just let's pretend for the moment there's not such thing as selling costs and taxes, right? And you've made $500,000 of it, and you receive that $500,000. that $500,000 can be treated like income. You can then go spend it for the next, whatever, 3-4 years, however long you want to stretch that money out. And so I think you'll make more money in growth than in cash flow. And I think that I just don't think that you need, like, the problem with real estate is it's illiquid, right? So you will get these big chunks. You like sell a property and you have a chunk of cash. And maybe that's an inefficient way, because then you have it in cash, then what's it doing? And, like it's less efficient and less effective. But I don't think, let's say you've got Bitcoin, I don't think you need to worry about like where does the cash flow come from? You could just sell a little bit over time. And let's say, and as long as you're selling less than what the average growth rate is, then your portfolio value would still continue to go up over time. Yep. So if the average growth rate trends down to say 25% or 20% as per the Michael Saylor model, and you're selling 4% of your Bitcoin every year to live off, and let's say you sell a little bit every single month, right? And you treat it like cash, then the difference is going to be an appreciation of 16%. And so you're not going to run out of Bitcoin as long as it continues to grow. It's the same thing. So this is why I think I don't know that we all need to seek out, like, how am I going to, have a pure cash flow play of 250 grand a year to cover my desired living expenses over time? Because even with real estate, let's say the objective is to get to a point where your property portfolio can pay you, let's call it 200 grand a year, right? Then yes, you're going to collect 200 grand a year of cash flow. It's going to take a while to get it. You can do it. It's fine. But you've also then got this portfolio, which is continuing to compound and grow. And that's great, but it's also not necessary. Like, so let's say that you've got let's call it a $15 million property portfolio, just for the point of the discussion. And it's producing 200 grand a year of cash flow. And you just live off the cash flow. Great. Fantastic. Then your portfolio keeps compounding to 20 to 30 to $40 million over time, over decades, right? So, or whatever. That's fine because your wealth is going up, but do you need it? Like, and this goes back to the kind of die with zero context. You're going to be living off this $200,000, little kind of budget, but you might have a 20 or 30 or $40 million property portfolio. It's like, well, I don't know. Like, maybe you should start actually spending some of that wealth. Like, do you really need to worry about it so much? So I've become less interested in like passive income strategies over time, and I'm more interested in how do you amplify capital in the most effective and efficient way. And real estate is freaking awesome, as we've just shown, at doing that. And if you can amplify your capital, you create more optionality. Because would I rather make $1 million or make $10,000 a year in cash flow for the rest of my life? Would I rather make $1 million in 12 months or have $10,000 a year or even more cash flow, or let's call it $10,000 a year for the rest of my life? Well, give me the $1 million, because then I can flip that into 2 million, into 3 million, into 5 million. And I can grow that massively to the point where I have a big enough pile of wealth that I can just live off my wealth. And I don't need to worry about the cash flow. So I don't know that we need to worry about yield bearing instruments. And I think that I think real estate is great because you do have rents. And I think that is a great way to generate some passive income, and passive income is good. But I don't necessarily think it should be the only thing to look at. And particularly with Bitcoin, I don't know that it needs to be part of the discussion, so to speak. You've got a highly liquid asset class, which grows really well. So if the value goes up, you can just sell it a bit.
Yeah, I think the point there being comfortable selling that, because as I said, Bitcoiners have this motto of hodl and hold forever, effectively. And so if you are, I don't know, if you get in at the right time and you have crazy amount of growth, like you said, you don't need to hold on to that huge portfolio value amount, despite it might still continue to grow 25% a year. Yeah. So you just sell off little bits as you need it.
I would ask you, if the objective was to never sell, why would you ever buy?
If the objective was to never sell, why would you ever buy?
Like, what functional purpose would it have? Like, what value would it accrete in your life if you were to? Now, maybe you're going to leverage your Bitcoin and you're going to live off the leverage. You're going to leverage and never sell it and hold it and leverage it, and maybe you could do that. But like on a very basic, exactly. But on a very basic principle, if the objective was to buy Bitcoin and never, ever, ever, ever sell any Bitcoin, die with the amount of Bitcoin that you bought, and never sell any of it. What is the point? What value does that add to your
Mm,
life? It doesn't add any
true.
value. It doesn't create,
True.
it creates nothing
It's all on
for you.
paper. Yeah.
Yeah, you could have $10 million worth of Bitcoin, but if you're never, ever, 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 ever going to spend any of it, who fucking cares how much Bitcoin you've got? It doesn't matter. Like, it doesn't matter. It's just numbers. You've actually taken real usable capital and you've effectively torched it, because if you're never, ever, ever, ever going to use it to improve the quality of your life, the quality of life of the people around you, the experiences you have, or anything like that, what is the point? The point of preserving your economic energy. So Bitcoin as a money preserves your economic energy to transport it through time and space, or the point of investing to grow your wealth is so that you can live a better life and have a better experience in this lived moment that we have in time and that you're sharing with your family, friends, and loved ones.
Mm-hmm.
If you're never going to spend any of it, what is the point? You might as well not invest. You might as well just not invest at all. Like, bugger it. So, I don't think that the hodl forever mentality works. You may not want to spend all of it. You may want to save some of it and keep it for your kids. Fine, all good. Same with real estate. But to say that you would never spend any of it, I would just question why would you ever do it? There's no point.
As always, it's what are you trying to achieve, right? Optimize for that.
If you're trying to lock up money and never use it ever again, then do that. So.
Well, because for a lot of people historically, it's like build wealth. A lot of the appeal with real estate is build wealth as this like legacy hand down generations mentality.
Yep.
Now, not everyone is like that, but that's, I don't know, something that probably applies to hold forever mentality.
Yep, totally.
Anyway,
well, I think we've covered this off. So hopefully this has been interesting and useful to see a side-by-side comparison of real estate versus Bitcoin. Hopefully the breakdown was detailed enough. Hopefully it was insightful and useful and eye-opening, because I think it really, really is once you start to really understand. Hopefully you now have a better point of view on why I say real estate is the best risk-adjusted return asset on the planet.
Yeah.
Australian residential real estate, particularly real estate that is bought working with Dashdot. So again, if you want to work with Dashdot, make sure you check out the link in the description and show notes, and make sure you join the community. If this is the kind of conversation you're interested in being part of, and you're interested in being surrounded by people who are like you, who are seeking to create a life of freedom, choice, and abundance, who are interested in investing in real estate, interested in things like Bitcoin, interested in technology, interested in freedom, interested in all of that wonderful stuff, then there's a link in the show notes and description to join the community as well. It is free. The only rule is the no dickheads policy. That is it. Gabby, see you next week. See you in a minute, actually. You're in the next room.
I'll see you in the next room. All right.
See you in the next room.
See you next week.
See you guys. Bye.